of the globe. So a very good morning to one and all. So as we are here late in the evening from the other side of the globe, it's great to interact with you all. So at the outset, we have with us a senior partner and my father, CAP Paul Sangam, who has been into this practice of chartered accountant for more than 32 years, and he has always been in this NRI advisory services. We also have with us CAS Ravinder, who has been a chartered accountant for more than 30 years, who has been abroad, who has been for a significant period outside India in the industry, and now back in India as an advisor with respect to various foreign exchange transactions. So myself, Aravind Sangam, being a chartered accountant for more than 10 years after qualification, we advise most of the corporates over here in India with respect to taxation, and we also advise NRI services with respect to their various tax planning activities in India. So a couple of words from our senior partner and father, CAP Paul Sangam. Ready?
Okay. Thank you, Aravind. Thank you for the introduction. Next,
and then introduction under foreign taxation, and then most of you be having relationship with regard to various
Paul, I'm sorry, Paul, your voice is breaking up. I think it's echoing. I'm not sure. Maybe if you want to get closer to your
video off.
Okay.
Okay. So I think already Aravind gave the introduction. So I think both our father and son, Mr. Paul and Aravind, are doing these services. Thank you, Paul and Aravind. Next is let me introduce Satya Eruva. So he's a CPA. Currently, he's actually working in state of Virginia. And the good thing is he also practiced chartered account in India for almost 10 years. So he has actually the experience in both sides, from India and also here. But currently he's a CPA. Mr. Satya, could you please provide a brief introduction about yourself?
Sure, Murray. Thank you. Hello, everyone. I'm Satya Eruva, CPA with Chuk Firm. Chuk Firm is a full-service CPA and attorney firm. We have offices in 7 cities in US, and we have affiliate offices in India as well, with more than 500 employees. I am based out of Washington DC office, and I practice mainly taxation, which involves cross-border transactions. So that's my practice area. Of course, looking forward to for this session. Thank you.
Thank you, Satya. And my name is Jayamariappan Kanapati. I'm a registered investment advisor, and so I founded Samatwa Wealth Management LLC, and primarily helping individuals and family and small business related to financial planning, retirement planning, asset management, and also the complete comprehensive financial planning. In addition to that, helping with 529, the college savings consulting, and coming up with the strategies to reduce their taxes, estate planning, all those services I'm providing currently. So the primary objective of today's session is I want to connect the Indian laws and also the US laws related to the repatriation. Who are attending, please mute your phone, or let me do it quickly one more time. Thank you. So before we start, I know this topic is primarily to kind of how to reduce the taxes when we sell the real estate assets in India and trying to then move the money or transfer the money to US, right? But let me spend maybe like 5 minutes quickly. There are a lot of strategies we can do to kind of recurring tax savings every year. So if you look at the slide, what I'm sharing, most of our guys either fall under the taxable income, let's say from 80,000 to 171K or 171 to 300K. So as you can say, see the tax rate is 22% or 24%. So that's the rate, the income, the taxable income will be taxed. as you can see, it's a very high tax liability, right? But the good thing is there are a lot of tools available to reduce the taxes. And also, if you look at this one, like a capital gains tax, so if you sell your stocks or ETF or any asset less than a year, then you'll be pretty much treat that as ordinary income. But at the same time, if you hold it for a year, then the tax rate will be only 15% because the long-term capital gains tax rate will be applied. Okay. So there are a lot of retirement savings tools available to reduce your personal tax savings. So the one thing I definitely recommend is go for the HSA first, health savings account, and then the next is your 401k. You can contribute 19,500. Then you can also consider the traditional IRA and Roth IRA, and also some of the states also offer 529 college savings plan. So I don't think we have enough time to go through these tools, but you can check my Facebook page. I did a previous webinar. I discussed a lot. And also you can check out a YouTube channel from Vijay Mogan, Investment Insight. I think he posted a lot of pretty good videos, and he covered pretty depth about these tools. Then if you are working as a like 1099 or Corp to Corp or S Corp or like LLC, then I would strongly recommend you can consider the SEP IRA, Solo 401k or defined benefit plan. So you can save or deduct probably around 57k to even 250k. So depending on your revenue, I would recommend you can consider these strategies to save a lot of your taxes. And again, all these are legally available options. So if you have any additional questions or anything, please reach out to us. And one more thing I would like to again reiterate. I know every session I keep telling our folks. So in our community, unfortunately, we are the first generation. Not many of us has the right amount of insurance coverage. So my recommendation is at least have a term life. That's all we need. Okay. So buy the term life for the correct term, right? Whether it's a 20-year or 30-year term. Then also for the right coverage amount, because I'm currently helping hundreds of clients, but unfortunately I keep finding our friends are not having the right term life insurance. Either they have signed up with their employer, which is just a basic, maybe like 150k or 200k. Definitely that's not enough. If something happens to you as a breadwinner, your family will be in a very miserable situation. And you guys already, we have seen a lot of GoFundMe campaign. So please take it seriously. So I would recommend, based on if you add up all those things, your annual expenses, your home mortgage loan, auto loan, credit card, it could be easily comes around $1 million. So my recommendation is at least buy 25 or 30 year, calculate when you are going to retire, then buy probably like a $1 million term life. So if you have already done it, that's good. If not, please make it as a priority. So the first option is you can use your employer, the supplemental life insurance, go for the maximum coverage. If not, then outside, definitely buy it. Okay. Then the next topic I would like to cover is, and a lot of questions we have received related to the gifts. So this is specific to USA. So in US, each parent or the grandparent, they can gift $15,000 per kid per year. So if it's married, then technically you can give $30,000. Up to that limit, there is no tax impact for you, and also no reporting is needed. And also you can directly give the gifts to open a custodial account. It's called UTMA or UGMA. Or you can also consider giving directly to the 529 college savings accounts also. Or another option is you can also transfer the money. You can set up a trust on behalf of a grandchild or a kid. You can also transfer the money, direct the money. But if it exceeds either the $15,000 for the single filing or $30,000 per year for a married filing, then you have to file this IRS Form 709 as part of your taxes. But the good thing is you don't have to pay any additional taxes, but you have to file this form. Then if you made this contribution, the gift beyond the 30,000, then the IRS allows you can count against the 11.7 million, which is a lifetime exclusion. Okay, so that opportunity is available. Then the next thing is from U.S. standpoint of view. So if you have a more than $10,000 liquid assets, you have to file FBAR. And also, if you have a foreign financial assets worth $50,000 if you're a single filer, or if it's a married more than $100,000, you have to file Form 8938, which is the FATCA compliance. So I would strongly recommend consult with your CPA. Okay, if you fail to do this form, then later on it could trigger huge penalties from US end. Okay. So the next is, I think we are going to talk about the funds repatriation. So before we move on to that, Satya, do you want to add anything else from US side?
I believe you have covered the 2 points, Murray, so nothing specific to add. But this is one of the common issue that we come across with our clients as well. A lot of clients, they kind of fail to file FBAR or Form 8938, even though it exceeds the limits of the requirements. So you need to check, everyone, they need to check if they have any bank balances. It's not only bank balances, so a lot of times we come across this question as well. So they have investment in stocks. So can that be considered in FBAR? Yes, of course, that needs to be considered in FBAR filing. It's not only bank balances which exceeds $10,000, any mutual fund stocks, even life insurance policies, and fixed deposits. So these are the important categories. If any of these, not only at the end of the year, even at any point of time during the year, any day, if the balance exceeds $10,000, FBAR needs to be filed. If at all, if you miss filing FBAR for past years because of lack of knowledge, then certainly we can go to IRS and file amended tax returns and file the FBAR filings for the past years as well. There are some programs that are available with IRS, streamlined filing procedure, where we can file it with minimum penalties. So there are some, certainly we would recommend everyone to review and comply this. Otherwise, penalties are huge, as Mari mentioned. The penalties goes up to $100,000 or 50% of whatever the account balances that you have outside of US. So these are the requirements, and yeah, certainly we can. If you have any questions, then I'll be able to answer.
Okay, thank you, Satya. So if you guys have any specific questions, so please continue to post your questions in the chat window. So we'll get to that. Okay. So next is the biggest topic for NRIs selling the real estate properties in India and wants to transfer the funds to USA. So yeah, I have highlighted all the steps, but before that, or I mean, do you want to go through some of the slides you have quickly? I think you can.
Yes, sir. Yes, sir. So we will just go through the presentation. If you can give me the presentation right, Salon, I'll just share the presentation right away, sir.
Sure. Okay. Give me a minute.
Yes, sir. So in the meantime, I will just have just a couple of words. Having gone through Mari sir's presentation and, like say, having heard from Satya as well, some basic things which we can understand. Is that yes, of course, there is a lot of difference between the taxation in India and the taxation that is happening out there in USA. We can very well understand the difference as well. The difference being so that, sir, are you able to see my screen now?
Yes, yeah, we can see your screen. Yep, please go ahead. Yep.
Okay, great. So, right, so my presentation is visible?
Yes, Arvind. Yeah, please continue.
Yes, sir. So, before I go on into the presentation, just to make a quick difference between the US taxation and the Indian taxation, the US taxation allows the parents to give a gift every year and which shall not be taxed in any of the hands of the kids or the parents' assets. That is something which I noted from Mari's slides. But if you come to India, you have to be a relative, number one. Number two, it should be on the occasion of marriage. So you can very well understand the occasion of marriage where you can really receive a gift and you can always say that it is exempted. We will just be discussing as such all those aspects now in the coming slides. So the agenda for the discussion in the next 10-15 minutes is going to be the following. Number one, what is the aspects relating to the purchase of property in India, investment in shares, investment in a business, gift received by an NRI, inheritance of assets, rental income, sale of immovable property, sale by Indian parents instead of the NRI selling the property. What if the Indian parents are selling the property on behalf of the NRI and then the amount is going to be gifted? What would be the implication? What are the various tax saving options, which is the most important and crucial aspect with respect to today's discussion, the repatriation of funds, and then the compliances under the income tax, right? So, income tax law of India. So, these are the most important aspects which we would be taking you through. If there are any clarifications, as Mari sir said, please put it across the chat box. We will definitely take it across at the end of the session. So, just to get initiated, first of it would be to purchase a property in India. So, a person who is a resident outside India, that is an NRI, can acquire any property in India other than an agricultural land, a farmhouse or plantation property. So, you can buy a commercial complex, you can buy a Kalyana Mandapam, say for example a marriage hall, you can buy any immovable property except these three things. And there is no restriction on the number of properties which a person can own in India. He can own 5 different properties, 10 different properties, 50 different properties. As long as it is not restricted under these three categories, he can own any number of flats, any number of villas across the length and the breadth of the country. So there is no restriction at all on the purchase of properties by an NRI in India. Coming to investment in shares and mutual funds, there is a scheme under the Reserve Bank of India guidelines which provides for investment through the portfolio investment scheme. Under this portfolio investment scheme, any NRI can buy shares through the stock exchange, through the NSE or the BSE, that is underlined to mean equity shares in the stock exchange. Other shares are not possible, or other equity instruments are also not at all possible. The maximum possibility by an NRI to invest in a company is restricted to 10% of the paid up capital. If an NRI wishes to invest in an IPO, say for example today, you should all know that Zomato came out with a very big successful IPO. IPO to mean an initial public offering, which is at the time of first time the company is getting listed in the Indian stock exchanges. Zomato came out with a very successful IPO, having been one of the first unicorns to have come out as an IPO. So being an NRI, if you would like to invest in an IPO or get yourself some shares at the time of IPO or invest in the mutual funds or something like a rights issue, it can happen not under the portfolio investment scheme, but it has to happen through a non-portfolio investment scheme, a non-PIS scheme account, that is a regular NRO account or an NRE account. So it cannot be a PIS scheme account, but it has to be a non-PIS scheme account. If you really ask me, how do you open a PIS scheme account or a non-PIS account? If you already have a banking relationship with any of the existing banks where you hold an NRO account or an NRE account, we can very well approach the banker to ensure that you are also having a PIS account with which you can invest in the shares or mutual funds of an Indian stock exchange. One thing, you cannot do an intraday trading. You are mandated to take delivery of stocks of any investments that you make. So intraday trading is just trading without actual buying the stocks. You buy in the morning, you sell it off in the evening. That is not allowed for an NRI. Investment in a business. Yes, an NRI can invest in any business. Generally, if you think of any business, textile business, automobile industry, any industry, yes, it is permissible for an NRI, except certain selected activities which are not permissible. Certain selected activities, that is chit fund, nidhi company, agricultural plantation activities. As I already told you, you cannot buy an immovable property which is of an agricultural land plantation property. So very similarly, even if it is for the activity of a business, you cannot really enter into any activity which is relating to agricultural or plantation activities. Real estate business or construction of farmhouses or trading in transferable development rights. Transferable development rights to say, whenever you give a land for the purposes of a joint venture to construct a building, that can be deemed, that can be construed as a transfer of development rights. So that is also not possible. That activity as a business is not possible for a non-resident. As further, with respect to a foreign direct investment, retail trading, atomic energy, lottery business, gambling and betting, agriculture. These activities are also restricted for an NRI. These activities are not allowed, actually, are not allowed to be done by an NRI. Any other business that you can think of, any other business is completely allowed for an NRI. There are some sectors where there are some sectoral limitations wherein an NRI cannot invest more than 50%, 51%, more than 26%, 74%. But those are selected sectors. But generally on the broad side, you can invest in any business in India. Gift. Gift received by an NRI is a very common transaction. So, as I already told you, gift received on the occasion of marriage is fully exempted. Gift received from a relative is fully exempted, but gift received from any other person, say for example, a friend wants to transfer an amount to you as a gift, that would be taxable in India, because gift is an amount which is received without any consideration, and it is an amount which would be deemed to be your income, even though you can very well represent to say that I have not earned it, it was just given to me, but it is very, very clear under the income tax provisions that gift received from any person who is not a relative, is taxable under the Indian income tax laws. So it is now very important to understand who is the relative. See, whenever we have to understand the taxation for an NRI or any transaction for an NRI, we have to look into it from two perspectives. One, from the perspective of the Income Tax Act, and also with respect to the Foreign Exchange Management Act, that is the FBAR guidelines. So the FBAR guidelines also have to be referred into, and as well the Income Tax Act. So now referring to who is the relative, we need to understand the definition of a relative as per the Income Tax Act and as well as per the FBAR guidelines. So right, before we go into it, who or what are the various forms in which the gift can be received? Gift can be in the form of cash, gift can be in the form of a bank transfer, where the amount of total gift that you can receive is restricted to $250,000 in a financial year. Financial year, as far as the Indian laws goes, starts from the 1st of April and ends on the 31st of March. So during this period, the maximum amount of gift that you can receive by way of a bank transfer is restricted to $250,000. With respect to an immovable property, you can receive any property other than those which I already indicated at the time of purchase. That is, you cannot get an agri land, a farmhouse or a plantation as a gift. So merely because you cannot purchase it, you cannot get it as a gift as well. Gold, yes, you can get gold. Investment in shares can also be received as a gift with the prior approval of RBI. Approval of the RBI is required, and then it is also subjected to limits. So investment in a company, that is when you want to purchase the shares, it is restricted to 10% of the paid up capital, but whereas when you receive an amount as gift, it is restricted to 5% of the paid up capital of the company into which you want to invest the money into. So maximum amount you can get as gift is 5% of the paid up capital, and the maximum gift which a donor shall give shall be restricted to $50,000 with respect to shares, $50,000 in a financial year. So these are the restrictions or the various forms in which gift can be received. Now coming to this definition as to who is a relative, the definition is a quite exhaustive one, but as long as a person fits into this definition of a relative, yes, it is all exempted under the income tax provisions, and it is also well permitted under the FBAR guidelines. The FBAR guidelines do not provide for any separate definition. The FBAR guidelines uses the same definition as is used in the Companies Act 2013 under the Indian taxation laws. So, any relative that you want to call yourself, in Tamil, Mama, in Hindi you want to call someone as Chacha, you cannot really bring them into the ambit of relative as unless it satisfies the definition of relative as per the taxation law. So, it is very, very important to read this definition, understand whether the person who is giving you the amount is a relative as per the provisions of the Income Tax Act, is a relative as per the provisions of the FBAR guidelines. Inheritance. So now we completed gift. Inheritance. So gift is something which you receive voluntarily. Inheritance is something which gets devolved on you. Is something which gets devolved on you. So when something gets devolved on you, pursuant to a will written by a person or pursuant to the death of any of the persons, then you cannot really restrict to say, see, this is something which I cannot get. Say for example, when I told you, you cannot buy an immovable property, you cannot accept on gift any immovable property which is in the nature of an agricultural land. So you cannot buy an immovable property in the nature of an agricultural land. You cannot also accept as gift any property as an agricultural land. But whereas when it comes to inheritance, there is no restriction on the type of immovable property which you would like to inherit. The inheritance, so therefore, can even be an agricultural land or a plantation property or a farmhouse. And even with respect to shares, there is no requirement for RBI approval at the time of inheritance. So you can merely get the shares shifted onto your name and continue to hold those shares, and it will not be restricted under any of the FBAR guidelines as well. Now, I have a property. We have acquired the property either by way of purchase or through gift. So, I have given this commercial property or this residential property on rent, and I am getting a monthly rental income. So, what will be the tedious deduction which my tenant would be obligated to do? The tenant will be obligated to deduct a tax outrightly on the rent amount to the extent of 30% plus cess plus surcharge. Approximately at the minimum of 31.2% would be deducted by your tenant, and the balance would only be remitted to your account. So, is the Indian taxation on the gross amount without any deduction? Say for example, you have a house property, you have a commercial property, there would be a lot of maintenance expenses which are to be borne by the owner of the property. That is, as an NRI, you would be obligated to maintain the property. So, are there any deductions which are eligible? So, with respect to computation of the income from house property, you are eligible to deduct the municipal taxes that you pay. Say for example, the property taxes, the water tax that you pay. You are entitled to claim a 30% of standard deduction from the rental income. If your rent is say rupees 1 lakh per month, accumulating to the 12 lakhs per annum, outrightly 3,60,000 rupees in Indian currency would be eligible as a deduction, irrespective of the amount that you have actually spent for maintaining the property. So standard deduction is eligible. The interest paid on housing loan, if any, can also be claimed up to a maximum of rupees 2 lakhs. The principal repayment of housing loan under section 80C can as well be claimed. As long as the rental income is concerned, you can claim if your rental income is above rupees 2 lakhs, then the interest paid on housing loan can also be claimed as a higher amount, but the maximum loss would be restricted to that rupees 2 lakh. If you have the principal repayment as well, that can also be claimed as a deduction under section 80C. 80C is the section which provides for various investments, and principal repayment of housing loan is an option which is eligible for an NRI. So being an NRI, you cannot continue to deposit in a PPF account. But whereas this deduction under section 80C will continue even if you are an NRI, and a maximum reduction of rupees 1,50,000 in Indian currency is allowed. Now coming to the most important subject for discussion, sale of an immovable property. So the property could have been acquired by purchase, gift or by inheritance. So supposing I have inherited or purchased any property and the property is other than an agricultural land or a plantation property or a farmhouse, such a property, say for example it is a villa or a flat, it can be sold to any person who is a resident outside India but he is a citizen of India. So even a person who is not a resident of India, that is a non-resident, but as long as he is a citizen of India, yes, I can give it to him. A person of Indian origin who is also resident outside India, to that person as well I can transfer the property. A person who is a resident of India, without any condition I can transfer the property. A person who is a resident of India without any conditions. But whereas if the property to be transferred is an agricultural land or a plantation property which has been acquired by way of inheritance, because you very well know it cannot be purchased, it cannot be received by way of gift, which has been acquired by way of inheritance. It can be sold only to residents who are Indian citizens. So a person of an Indian origin can sell such a property to only a person who is a resident and who are Indian citizens. But whereas if you are an NRI, that is you are an Indian citizen, then you can sell it to any resident. He need not be an Indian citizen. Even though he is not an Indian citizen, you can sell it to any resident of India. So this is something which is to be a fine difference between a person of Indian origin and a non-resident Indian. So what is the process for sale? You need to execute a power of attorney in favor of the parents or the family members for signing the sale deed. If you are visiting India for executing the sale deed, then this process would not be required. The buyer would deduct TDS. TDS is nothing but the deduction of tax at source. The income tax which is payable to the department, the government says at an ad hoc rate of say 20%, deduct this amount and then remit only the balance to the person who is earning the income. So TDS is nothing but the deduction of tax at source, or simply to say the withholding tax. So the buyer will deduct 20% plus surcharge purchase as applicable. The amount as per the agreement less TDS would be remitted by the buyer and it shall be remitted into your NRO account. You shall file Form 15CA, get a certificate from a chartered accountant in Form 15CB and file both the forms in the income tax portal. These forms 15CA, 15CB and any other required form from the bank shall be submitted to the bank for transfer of that amount to the NRI account or to the bank in USA. And after the end of the financial year, that is from the 1st of April to the 31st of March, you shall after the 31st of March relating to the year in which the transfer has happened, you can file an income tax return and claim a refund. If there is any, then you can claim a refund because tax has been deducted on the gross amount. TDS is being deducted at 20%, which can be much higher than the actual tax liable on the transaction. Therefore, you are entitled to obtain a lower deduction certificate, which is an online process and for which you need to upload some document and obtain a permission from the department for a lower deduction of tax. And certain caution points which out of experience we earnestly request you to avoid is: number one, never execute a power of attorney in favor of your buyer and receive your consideration. The issue would be that the person who has received the power of attorney would not register the sale deed immediately, but the sale deed would be registered at least almost or even after 3 years, 4 years or even after 10 years. The tax liability on you would be dependent only on the day on which the sale deed is effected and not based on the power of attorney. Power of attorney very clearly will note that no consideration has been received towards execution of this power of attorney. So therefore, it cannot be considered as a sale deed at all. You will be executing a power of attorney for effecting a sale deed, that is in favor of your close relatives. But the caution point is with respect to entering into a power of attorney in favor of the buyer itself. So that is an aspect to be avoided strictly. And whatever is the amount which is part of the agreement can very well be deposited into the bank. Any amount not part of the agreement cannot be deposited into the bank as such. If the property is in the name of the Indian parents and you are coordinating with respect to disposal of the property in name of the Indian parents, the TDS amount would be different. The tax deduction amount, the withholding tax would be at the rate of 1% as against 20% plus surcharge in the case of a non-resident. All other transactions, all other aspects would remain the same. But since the TDS is deducted only at the rate of 1%, you may be required to pay advance tax at the next coming installment. That is something to be ensured, because payment of tax at the time of filing returns may attract interest which is unnecessary. What is the rate of tax with respect to sale of an immovable property? The rate of tax is generally 20% on the capital gains. So whatever is the amount of capital gains on which tax has to be paid at the rate of 20%. But TDS is being deducted only at the rate of 1% of the sale value. So how is this capital gains being calculated? From the sale value, you are eligible for certain deductions. Number one, any commission or any other expenditure which has been incurred at the time of sale of the immovable property. Number two, indexed cost of acquisition if it is a long-term capital asset. And say for example, if the property was purchased prior to 1/4/2001, then you can get an indexation of up to 3.17 times, almost up to 3.2 times of the original purchase value can be taken as an indexation, and only the difference between the sale value and the index cost of acquisition would be treated as capital gain. On this capital gain, 20% tax would be payable. If suppose you had purchased the land and you had built a residential house, this house is going to be sold along with the land, then the construction of the house will be called as improvement, not the regular maintenance, but the construction of the house would be called as improvement, and you would also be eligible to reduce index cost of improvement at the time of calculation capital gains. So after reducing these three amounts from the sale value, you will arrive at capital gains, and on this capital gains you will be required to pay tax at the rate of 20%. The same computation holds good for NRI, same computation holds good when the property is held by a resident. So, but whereas in the case of a resident, TDS will be deducted only at the rate of 1%. How do I save tax? If you are open for reinvesting the amount into India itself, into a property or in any tax saving bond, then the capital gain tax can be saved, subject to the condition that when it is a sale of a residential property, you need to buy another property within the time limit given, within a period of 2 years. If it is going to be construction, within a period of 3 years. If it is going to be any long-term capital asset, I had gold in India, I would like to liquidate that gold. Yes, gold sale would also attract capital gain, and you can invest that amount into bonds. Say for example, NHA bonds or REC bonds, which would get you 5% rate of interest, locked in for a period of 5 years, and then there would not be any capital gains. But the maximum amount of investment that can be made into this NEC or REC or NHA bonds is ₹50 lakhs in a financial year. The long-term capital asset amount can also be invested into purchase of any other residential house, but you should not own more than one residential house at that point in time. Now coming to repatriation of funds, the maximum amount which can be repatriated is restricted to $1 million USD. Yes, above that limit is also permissible with RBI approval. With RBI approval, it can also be repatriated. For repatriation of funds, you would be required to file Form 15 CA and a certificate from a chartered accountant in Form 15 CB may be required. So, what are the various compliances under the Income Tax Act? PAN, a permanent account number, which is very similar to an ITIN number in the USA. PAN is a mandatory aspect for every transaction, but whereas Aadhaar is not mandatory. But even if the income is exempted, say for example, you have reinvested the amount into purchase of bonds, you have reinvested the capital gain amount into purchase of another property, still filing of income tax return would be required whenever the income has exceeded the amount of ₹2.5 lakhs in Indian currency. So filing of return would be mandatory. And any NRI having an Indian income above ₹50 lakhs has to give the details of asset liability statement in the income tax return. So that is also something which is to be taken care of. But whereas there are a lot of relaxations with respect to filing of an NRI return, you don't have to give the details of foreign bank assets, foreign bank accounts held. Only and only if you have to receive a refund, and the refund is to be credited to the foreign bank account, you need to give the details of the foreign bank account. Otherwise, if you are an NRI, it is not required. But whereas if you are a resident and you are holding any foreign bank account, any foreign asset, then it has to be disclosed. So there are various relaxations given in the filing of income tax returns. But filing income tax returns, as long as you are having income, it will be a very crucial aspect. So these are some of the broad overview. We can very well take up a lot of questions during the panel discussion. If there are any other questions as well, we can take it up. So Mari sir, over to you, Satya sir. Thank you.
Yes, thank you, Arvind. Let's see. Let me bring back my slide. Okay, I think we can now go for the. Okay, so thank you, Arvind. I think as you guys see, I think Arvind went through a lot of details, right? So one thing I would like to point out to everyone. So selling properties in India, definitely it's kind of a lengthy process. We all know the real estate, it's not a liquid asset, right? Not like stock or something you can sell immediately. What we consider a real estate is illiquid. It can take maybe 6 months or even 1 year to sell the property or even transfer the fund. So as you can see, there are a lot of steps involved. So I would recommend if you guys have some plans, okay, to sell this property, then start planning now. Okay? Particularly if you want to go back and settle in India, I think that's fine. You don't have to worry about it. But you are planning to settle in US, right? Then I would recommend seriously have some plans. I would say long-term plans, how to sell this property and repatriate. Because getting a trusted person is very, very difficult, as you guys already know that. And imagine, don't think that our kids will be able to go back to India and handle these paperwork. That's totally, I can immediately say that's impossible. Even for us, if you go back, I think we are going to struggle. Because since the last 20, 25 years, a lot of things have changed. So that's why I would strongly recommend understand all these processes. I can quickly recap what Arvind said. So start applying for the PAN card, get your tax ID, and find out the trust person, maybe your parents who can deal with all the power of attorney. Then doing the sale agreement and start valuing the property, computing the taxes. You have to definitely work with the chartered account, and then start discussing the tax saving options. Or then understand what is NRE account, what is NRO account, and how to fill the 15 CACB form, and then finally file the taxes in India. Then after you do that, then as we discussed before and Satya pointed out, and doing the proper FBAR and FATCA form, and also include that income as part of the US tax filing. And we also talked about the gift. So plan what purpose you are selling this property. Maybe use those funds for maybe your kids' college education, or for your retirement plan, or maybe buy a property here. If you don't have anyone there, maybe you can sell all those things. You can technically then buy a properties here. So all those are different investment strategy, and it kind of varies from person to person, right? It's a personal finance. I would strongly recommend discuss with your advisor and see, and then do the right thing, what's appropriate for you. And as I said, definitely it's a complex process, but it definitely is not a rocket science, and we have all these steps identified. So let me move on to, before the panel, just a few things. Under the Foreign Exchange Management Act, there are a few things. I think it was passed in 1999. They have a lot of rules, but there are few rules very important. So the first thing is, what I found is, as an NRI, you can only maintain the NRE or NRO account. Unfortunately, you cannot maintain the residential bank account. And also, you cannot lend and borrow directly from your friends in India. Apparently, that's not permitted. But you can lend and borrow between your close relatives, but I believe there is some amount limitation is there. And also, I have come across a lot of situations, people paid dollars in US to the friends' kids' college expenses because they moved here and doing their college study. In turn, they get the equivalent money back in India as a rupee, or vice versa. So please don't do that. I found out basically this has been treated as a hawala transaction, which is totally illegal. So with that, let me quickly go to the panel Q&A. So we have around 20-25 questions already submitted before this session start. So let me request Niti Patakanti, one of our intern. So please, Niti, please go ahead and read this question. Then I will direct to our panel members to answer the questions. Please start.
Yeah, so the first question is, what is the process to bring money from India by selling ancestral property?
Okay. Aravind, do you want to take this? I believe you have covered a lot, but yeah, please go ahead.
Yes, sir, I think this is already covered. So by selling ancestral property, if it is in the name of the NRI, then the buyer would deduct TDS at the rate of 20%, and after which you get the money into your NRO account. From the NRO account, you file Form 15CA, 15CB as required. If it is above 5 lakhs, you would require 15CB as well. File Form 15CA, 15CB, transfer the money to your NRE account or directly to your US account. So this would be the process, and otherwise there should not be any other complications.
Okay, thank you, Arvind. Niti, let's move on to the next question.
Should the money can the money only be transferred to adults, or can it also be transferred to minors with that adult as a guardian?
Satya, do you want to answer this one since it's kind of comes under US?
So there is no restriction as such, I believe. The money can be transferred to even minors also. But the thing is the bank account. How you have minors cannot open the bank account. So I'm not sure what exactly the question meant, but as a legally there won't be any transaction. You can transfer it to anyone, but the other aspects of it needs to be taken care.
But in addition to that, I think if it's a gift, then I think they can, Satya, my understanding, they can directly give it to the 529 account or the UGMA, UTMA accounts, right?
Oh,
the
yes, of course.
account.
Yeah.
That's possible.
Cash. I was talking about the cash. Yeah.
Right. Okay, got it. Thank you. Yeah, please go ahead, Niti. Next question.
So suppose we have an NRO or any NRE account. If we want to move the money to the US, what is the process?
Okay, see, from the non-resident external account, moving the money to USA is freely allowed. From the NRO account to the NRE account or directly to the US account, you need to file the form, you need to explain to the bank the source of the money, and then you can transfer the amount back to the NRE account or directly to USA.
Thank you. Yeah, let me quickly clarify what is the NRO and NRE account for those who are not familiar with it. So NRE is basically whatever the money you are earning, the foreign earnings, you can deposit into your NRE account. So the advantage is there is no taxes you have to pay to the Indian government. So that's the advantage of NRE account. But for the NRO account, whatever the earnings you are making in India, for example, let's say you are getting a rental income from your rental property in India. So you can put that in your NRO account, or when you are selling an asset, or when you are selling stocks or mutual fund, when you look at it, so technically you can move all those into your NRO account. So typically there is not much paperwork involved when you move from NRE account to NRO account, but if you want to move from NRO account to NRE, as Aravind mentioned, you have to do all those tax forms and then even file taxes. Then only you can transfer from NRO to NRE account. Then ultimately you can bring it to your US bank account.
I would like to add one more point here. I think from NRO account the limit is $1 million. Correct me if I'm wrong, Arvind.
So yes, sir. As per Sharma guidelines, maximum amount is restricted to $1 million USD in a financial year.
Yeah. And then under the liberalized remittance scheme, it's $250,000. Even there is no need to inform RBI or no need to take any approval.
Yes, sir.
Thank you, Satya. Okay, Nidhi, let's move on to the next question.
So the next question is, what is the process to avoid paying tax or liabilities? So if grandparents want to send money to children and grandchildren, for grandchildren the money can be moved to 529, but if they want to give it to their children, what's the process?
I think, Arvind, I believe we have covered. I don't think we can avoid. Avoid means we can reduce the taxes. Arvind covered a lot of different strategies. You can do indexation, or you can add whatever the improvements you did to your properties. But I think for regarding the 529, definitely the grandparents can send the money to the grandchildren. I think I mentioned in the part of the slide presentation. So each grandparent can do a $15,000 to their grandchild. They can technically directly contribute to the 529 also if they want. Yeah, please go on. The next question.
And suppose there is some land, if we bought land in India with the money coming from the US, if the property is sold off, what's the process to bring that money while minimizing the taxes?
Sir, as I explained already, the capital gain tax is payable only on the difference between the sale value and 3 deductions. 3 deductions are already eligible. So the amount which you had already given at the time of purchase of the property is given an indexation benefit for the increase in the prices, and only after which you are computing the capital gains. So therefore, yes, you can minimize the taxes. The commission paid is eligible as deduction. The index cost of acquisition and index cost of improvement is also eligible. And if you want to reinvest the amount into India, yes, you have some reinvestment options also when you have to buy another property or reinvest in bonds.
So I would like to add one point from US tax point of view. Yeah, so certainly from we need to look this transaction into both India tax point of view and as well as US tax point of view. So basically what happens is from India point of view, whatever the land that you sell, the gains that you have, you can reinvest in other capital gain bonds or something, right? And you can save some taxes there. But when it comes to US, if the person is US resident, then you have to report that gain and pay taxes in US as well. And you can take the credit for the tax paid in India. If at all, if you don't pay any tax in India because of investment in other capital gain bonds or any other residential property also, but still you have to pay tax in US. So that is one thing that we need to kind of consider before doing the transaction.
Thank you, Satya and Arvind. Nidhi, let's move on to the next question.
If we hold stocks in Indian companies in Demat account in India, do you recommend liquidating them and bringing that money back here to the US? And if so, what's the process?
Arvind, do you want to take this?
Yes, sir. Sir, liquidating the money from the stock market is a conscious call. If you want to take the money, yes, you liquidate it and you take it back, or you hold it, you wait for the investment to go higher and higher. So it is just a personal call. So yes, you can continue to hold the stocks in the Demat account. There is no restriction on it. But liquidating or not is your personal choice. And we are having a very bullish stock market today. It is on the upward trend. Since it started going up in the mid of 2020, in the mid of the first wave of the COVID pandemic, it has always been going in a very good level today. So we don't really, I am not the best person to predict. I leave it to Mari sir if he has to comment on the Indian stock market, please.
Okay. But for the transferring the funds for the stock, the process is going to be the same thing, correct? I mean, they have to still file the capital gain taxes, then do whatever the forms, then move it to NRO account, then transfer it. Is that right?
Yes, sir. The process always with respect to repatriation amount would remain to be the same. Any repatriation is restricted to the maximum amount of 1 million USD, and you shall be bound by the same transfer the amount to your NRO account, from the NRO account to your NRI account, file form 15CA, 15CB and transfer the amount. So the process will remain the same with respect to all repatriation.
Okay, got it. Thank you. And Satya, my understanding from US point of view, again, we have to disclose that also, right? It doesn't matter whether it's from the stocks or real estate.
Yeah, of course we need to, if the stocks are sold in India, we need to report that here, and then we need to pay capital gains taxes. But again, there is no duplication of taxes. If there is some tax already paid in India, we can take the credit in the US. Having said that, if you don't sell it and you keep that in demat account in India, FBAR form certainly that is applicable. We need to file that. And other than that, there is some other form that we need to file from PFIC rules that are applicable. So that needs to be filed along with the US income tax return.
Okay. Thank you, Satya. Okay, move on to the next question. Nidhi?
What are the tax implications of repatriating cash to NRIs that are gifted from relatives or inherited?
Gift from a relative or inheritance is not subjected to any tax in India.
Okay, but they still have to file the forms though, right? They still have to do all the forms, right? Same process.
Yes, sir. Filing the forms should continue. Yes, sir.
Okay. I'm sorry, Satya, you are trying to say something?
Oh yeah, this is a very interesting topic, Mari. We come across this situation very often. So basically, either gift or inheritance. So that we have to plan it very carefully. So if you have some, if anyone needs that money urgently, then certainly you can get it as a gift and then transfer that money to US. But if you have a choice, then certainly need to look into between gift versus inheritance. So having these assets transferred via inheritance has certain tax advantages from US tax point of view. The simple one example I can give. So for example, if someone parents in India, so they have property of 1 lakh rupees. Let's say that, let's take that as an example, which was bought kind of 20-30 years ago. Now the market value is 1 crore rupees, let's say. So if we take it as a gift, so that gift is entire amount, let's say entire amount is transferred to US. Tomorrow, if the person NRI and whoever US person, if they sell this gifted property, then capital gains tax needs to be paid on the difference between 1 crore or whatever the sale consideration minus the actual value in US. But if at all this property is through inheritance, so the fair market value as on the date of inheritance, that is considered as a cost basis. So for example, again taking the same example, 1 lakh rupees was the value of the property when it was purchased. 1 crore rupees is at the time of inheritance. And for example, if that property is sold for 1.5 crores. So in this case, 1 crore is considered as a cost basis, and only 50 lakhs capital gains tax needs to be paid in US. Whereas in gift case, it has to be capital gains tax will be paid between the difference between 1.5 crores and 1 lakh. So which is kind of 1 crore 49 lakhs. So this is a very, very good tax planning opportunity. And if at all, if the amount is not urgent or if you can wait, then certainly inheritance route would be a lot easier and cost effective.
Thank you, Satya. Great advice. Okay, Nidhi, let's move on to the next question.
So if parents hold mutual funds and stocks and they're inherited, can they just be held in the NRI's India brokerage accounts without liquidating? And what would be the tax implications of such inheritance both from the India and US perspective?
Aravind, let's start with the Indian side.
So with respect to Indian inherited stocks, the NRI can continue to hold such stocks, and at the time of liquidation, it shall
be that same as a real estate asset?
Yes, sir.
Is that the same law?
The same. It's the same.
The same. Okay. So then, Satya, the tax is also then same Like
yeah,
the real
it's the
estate?
same. It's the same laws are same. It's finally at the end of the day, it's a capital asset, whether it is a property or stock. Again, as I said, if the stocks have a different rules from US point of view, PFSC forms needs to be filed, and then FBAR forms are 8938. These are the things that we need to consider while filing US income tax returns.
Okay, got it. Thank you. Yeah, maybe let's move on to the next one.
Usually property sale in India, we end up with major portion as a cash sale. So how can we repatriate the cash component of funds to USA?
We limit the discussion entirely to the amount which has been recorded in the agreement and which is part of the sale deed. So any amount which is not part of the sale deed cannot be subject matter of discussion in this forum as well, and which cannot be directly transferred back to the USA.
That is absolutely right. Yeah. Unfortunately, nothing can be done.
Yes, madam. Madam, we will move on to the next.
Move on to the next question, maybe. Yeah.
So a participant said that he or she has some Indian shares in the Indian demat account invested more than 10 years ago. So what are the options to bring it back?
Yes, madam, already addressed.
Yeah, we already discussed the same process. Yeah, let's move on to the next one, maybe.
Many NRIs have ancestral properties and they have migrated to the USA and they have no connection to India now. So how can they dispose of the properties, or are there any specific processes or tax obligations?
Yes, sir. So since it is an inherited property which might have been bought a good time ago, number one, you need to find out what was the value of the property as on 1/4/2001. So that would be a very essential exercise which has to be done at the ground level. Number two, you need to execute a power of attorney in favor of a very trusted person, a close relative or someone, so that he can sign the sale deed form on behalf of you. You would need an Indian PAN number, an Indian bank account into which the proceeds of the sale can be deposited into. The bank account shall be an NRO account, and from the NRO account you can transfer the amount to your NRI account and to your US account based on filing of Form 15 file your income tax returns. So this should be the process as such.
Okay. Thank you, Arvind. Maybe let's move on to the next question.
So resident Indians can save on the capital gains tax with investing, but what can NRIs do to avoid the tax?
The tax investing and the tax saving options which are available to a resident are equally available to a non-resident as well with respect to capital gains taxation. So the only thing is, with respect to sale of an agricultural land, you cannot buy another agricultural land, which is one of the restrictions, which is generally for any purchase of any other property. But for any other investment option which is eligible for a resident is generally eligible for non-resident as well, generally. So if you have to buy any other property, invest in bonds, yes, you are eligible for the exemption as equal to a resident.
Just to add one point from US tax point of view, even though you can save some taxes by investing in capital gain bonds or residential property, but US you have to pay tax. So the persons residents of US who are filing obligations in US, they have to pay tax here.
Okay.
Sir, will not the double taxation avoidance agreement help to say that since this is a transaction in immovable property, this shall be taxed only in the contracting state in which the income arises, and it shall not be taxable in the other state at all?
Yeah, it's not taxable in other state, but the person who is filing the US income tax return, they have to report their worldwide income. So when they report their worldwide income, they have to include the capital gains of irrespective of the country, so even if India or other countries.
Okay, and it will also be included in the computation of income tax as well.
Right.
Okay, great.
Okay. Thank you, Arvind and Satya. Maybe let's move on to the next one.
NRI who owns an agricultural land in India, can he sell the land and repatriate the money, or are there any restrictions?
Yes, sir. He can very well sell the land, but there are restrictions as to who he can sell the land to. He cannot sell it to any other non-resident. He cannot sell it to a person who is not a citizen of India. So those kinds of restrictions are there depending upon whether he is a person of an Indian origin or an NRI. So there is a small differentiation between a person of Indian origin and NRI with respect to the sale of an agricultural land as to who he shall sell the land to. So therefore that alone shall be taken care of, but otherwise you are eligible to sell the land and repatriate the money back to USA.
Okay. Thank you, Arvind. Maybe you can skip the next one. I think it's a duplicate question. Let's move on to the third one. Yeah.
How much NRI needs to pay for TDS, short-term versus long-term? Is there any other options available to reduce TDS?
Okay. So TDS is something which is just a withholding tax, which is just temporary. So the tax payable amount will change depending upon whether it is a short-term capital asset or a long-term capital asset. But whereas the withholding tax amount will remain to be the same irrespective of whether it is a short-term or a long-term asset. So therefore, this is only a temporary aspect, but whereas the tax rates would be different.
So you're saying, Arvind, there is no short-term, long-term. I'm sorry, there is no short-term, long-term with respect to TDS at all. It's a flat, right? Based on
TDS is flat rate. TDS is flat rate, number one, and you can apply for a lower deduction tax from the income tax officer. It is an online process. It's an online process. You need to file form number 13 in the online process, and you need to upload some documents. And on the approval of the assessing authority, you can get a lower deduction TDS. Previously, it was lower or nil deduction. Now they give at least lower deduction. So you need to indicate what is the lower percentage that you want. Give them the computation. Tell them that this is what my income is going to be. So deduct TDS only. Give me a deduction certificate only for this amount. So based on the certificate, you can go for a lower deduction certificate as well.
Okay. Thank you. Let's move on to the next one.
Is there a limit to transferring funds from India to US?
Yeah, I think we already talked $1 million US, correct, Arvind? Per year.
Yes, sir.
Okay, let's move on to next.
I think that 1 million is transferring from NRO account. Otherwise, the limit is $250,000 under a liberalized remittance scheme.
Okay, got it.
If an NRO account is not used.
Not used. Okay, thank you, Satya.
Is that 250 annual limit or?
It's an annual limit, yes, per person.
For a financial year.
Yeah.
Okay.
Thank you.
Thank you. Okay, yeah, Nidhi, let's move on to the next question.
What is the best or recommended practice to sell properties and to transfer funds?
Yeah, I think it's a duplicate. We discussed all these things before. Let's move on to the next question.
Is it best done while on green card or wait until we become citizens to do so?
Satya, do you want to take this one?
So this is related to the previous question?
No, I think they're asking, yeah, correct. They're asking to sell and transfer. Is it better to done while in green card or wait citizens from taxes point of view?
From US tax point of view, I don't see any difference as such. So the capital gains tax has to be paid. And green card and our citizenship, US tax doesn't have any difference as such. And they have to pay capital gains tax on worldwide income.
Okay.
So from the Indian taxation perspective as well, it is only based on the residential status. So the citizenship will not be the criteria for deciding the taxability prima facie in India. So you don't have to, there is not going to be any difference at all.
Okay, got it. Thank you. Yes, Nidhi, let's move on to the next question.
How much money or funds can my parents send to us during financial year? Is there any limit, and is it taxable to either receiver or sender?
It is exempted, the gift is exempted, and the monetary limit also discussed. You can go ahead.
Yeah.
Yeah, so one interesting thing here is, see, in India, if it is a gift, the receiver has to pay gift tax, right? So that's as per the rules in India. And of course, if it is from parent, then there is no gift tax at all. But in US, it is the donor who has to pay gift tax, if at all, if it exceeds some limits. So either way, if as persons, donors are based out of India and donees here in US, then neither India tax is applicable or nor US tax. So there won't be any tax impact as such for this kind of transaction, both in US and India.
Yeah. Okay. Thank you, Satya. Maybe let's move on to the next question.
Okay, so one of the panelists said, like, my parents are retired and they wanted to sell their property in India to move to a smaller one. They want to gift or send the money from sale and retirement to US in the next 2 to 3 years. So how can they send this money, and is it taxable, or will it be taxed?
So Satya, for this one, it's kind of comes under gift, so they could technically use the LRS option, right? to give the money. Okay.
Yeah, so the gift is again the same rules are applicable, so they can liquidate and send it as a gift. From India tax point of view, gift between relatives or not is exempted. So, and in India, it's the donor who has to pay gift tax or who has to file gift tax returns. As here, the receiver is kind of based out of US and the donor is based out of India. Then there is no complaints as such that is required.
Okay.
And again, transferring of the money, same regulations applicable. So $250,000 under LRS scheme.
Okay. Good. Okay, let's move on to the next question.
Is the next question also repeating like the transfer process?
Yeah.
Yes, yeah, we can skip that one. Yep.
This one is, what is the liberalized remittance scheme, and is this person eligible?
Sorry, Nita, I think the previous question we did not cover it. So basically the question is, if you sell the property in India and they are paying taxes in India and then again paying taxes in US, so their question is, are we not paying double taxes? That is a question that we discussed, Arvind. So here it is not paying double taxes. Whatever the tax that is paid in India, they can get tax credit in US.
Yes. Okay. Good.
The next question is, what is the liberalized remittance scheme, and is it eligible to transfer money through LRS? And how much money can be transferred, and what would be the procedure? Or could you transfer it as a gift to children for gift tax?
Yes, sir. Yes, sir, you want to take this question? So $250,000 is eligible to be transferred under the LRS scheme, and it would not be subjected to tax as long as you are sending it to your children. It is going to be a gift which would not be taxable.
And also, Satya, here also it won't be taxed, right? Since it's under, and if it's above the $30,000 married, then obviously we have to file the required form. Then it will be maybe applied to the lifetime exemption. Is it?
Yeah. So again, here it is the receiver, right? They are receiver. Right. They are not the donor. Right. So the 15,000 exemption limit that is applicable for the donor, and donor has to file those forms. But in this case, as they are the receiver, as such, there is no need to file any form.
Correct. Okay. Okay, let's move on to the next question.
So if someone bought lands or apartments in 2003 to 2007 using money transferred to India from US, they plan to sell it now, should they show the source of the fund, like the NRI bank statement, at the time of the purchase?
So the document for evidencing the purchase would be required. The bank account would not be required. At the time of purchase, there would be a purchase document, and the purchase document would be the basis for computing capital gains. The bank statement per se would not be required as such. So in any extreme situation where the department wants to ascertain whether the purchase was properly made, then they will be requiring us to produce a copy of such bank statements. But otherwise, in the general situation, you would not be required to produce a bank statement.
But my understanding, you'll use that inbound remittance to calculate the tax computation and stuff, right?
Not the inbound remittance. See, the inbound remittance could have been used entirely for the purchase of property or retained in the same bank account. So, the value which is indicated in the purchase document. So, whenever you are purchasing a property, there will be a sale deed which has been executed by your seller onto your name. As an NRI, you are the buyer. So, that NRI buyer will have a document which is evidencing the title of the property in his name. The value entered in such property document would be the basis for computing capital gain. So, not any inward remittance. So, generally, we can go by the standards, sir.
Okay. Yeah, let me add to that. I've seen sometimes some of my clients are in a situation, they are sending the money to their relatives, or even maybe like, let's say, parents or their brothers, but they are buying the property for them, but technically under, let's say, their name. So how do they handle when they sell, even though the NRI point of view, I gave the money, they bought it, right? But technically the property is either under their brothers or maybe their parents. So how to get it back? What's the process in that case?
Okay, sir. So whenever you are sending, let's assume you are going to give the money to your brother or to your father, and, or to the parents who shall buy the property in their name. So transfer of money from an NRI to their brother or their parents, that is a gift which is not taxable anywhere in India. And then thereupon there is a property which is being purchased which is independent of the NRI relationship. The father, the mother or the brother buys the property in their own name. That is retained by them as their own property. The law does not deem it to be a property held on behalf of the NRI because it is a property held in their individual name. And at the time of disposal, based on the relationship between the brother or with their parents, the property is disposed. The money that is getting taken into the account of the person who is a resident in India, and after which it is given back as a gift to the NRI. It is given back as a gift because they are still falling under the definition of relative under the Income Tax Act, relative under the FBAR guidelines. Therefore, that gift would be very well permissible, and such amount can be transferred back to the NRI. So,
so that time no taxes at all then. It won't involve, even if, assuming if the brothers or sister or the parents agree to again gift it back, then no issue then, right?
Yes,
but in
no,
case
if there will be tax which should be paid by the resident in India, there will be tax which would be paid by the resident in India, which would of course be deducted by such person, and the balance should only be given.
Okay, got it. But if due to some family problem, I know our family sometimes because of family issues, right, whether among the brothers or even parents, then if they decided not to give anything, that means the property is gone, right? Nothing can be done from NRI side, right? Is that right?
Nothing at all, sir. Nothing at all, sir. You have given it, and you have given it out of free will as a gift to your brother or to your relative, and then after which it would not be possible to recover.
Okay.
And unless it is settled by you fully.
Correct. Okay, got it. Because I know I am getting a lot of questions, so I want to make it clear. So,
right.
Okay. Thank you, Arun. Okay, good. So now I think we covered all the panel questions. So Niti, let's go to the chat window. You can start go through those questions.
So
there have been a good number of questions on chat, and most of the questions have been answered by Father. Like say most of the questions. So if there are any unanswered questions, there have been a really good number of questions, as you can see from the chat box.
Sure. Yeah. So Niti, anything duplicate, we can skip it. Anything we haven't answered, we can cover. Please go ahead.
So the first question was, so a kid can get up to $60,000 per year from 4 grandparents and they don't need to file a tax, or does it need to be reported?
Satya, do you want to take this one?
Yeah, so there is no need to file tax return as such, as long as there is no income that is earned on this amount that is received.
Okay. Thank you. Nidhi, let's move on to the next question.
There's a couple questions about the FBAR filing. So first, if you have land, does it come under the filing, and how would you handle ancestral property with it?
Oh yeah, so land or any property that's not counted against the FBAR amount. So there is no need to report under FBAR.
Nidhi, let's move on to the next question.
And then, do they need to file FBAR for LIC when the policy is not matured yet?
Oh yeah, so this is another good question. So for LIC, it is not the value of the LIC amount that is considered for FBAR amount, but it is the surrender value. So as at the end of the year, we need to look at the surrender value of the LIC, and then if it exceeds $10,000, then we need to file the FBAR.
And then real estate in India, would it be counted to 50K single or 100K married for the Form 8938?
Oh, for Form 8938, real estate in India is not counted. So there is no need to worry about.
Okay. And then at what age do you recommend parents and grandparents give money to young kids through the UTMA account?
Mari, you want to take this?
I'm sorry, could you please repeat the question now, Nidhi?
Yeah, sure. At what age do you recommend parents and grandparents gift money to young kids through the UTMA account?
Yeah, they can do as long as I think the kids age turned 18. So until then, basically you will be the custodian of that account. So when they are even in the kindergarten or preschool, it doesn't matter. As long as they are under 18, you can contribute to those custodial accounts. Okay.
And then how the gift to kids from parents should be given. So if the gift money is transferred to investments such as stocks and they incur short-term or long-term gains, how is it considered income in family filing jointly?
So there are certain limits for a kid to file the income tax return. So if the income exceeds that limit, certainly it's always recommended to file the income tax return on the kid's name. So so the limits and all, probably we can if they send us the email also, then we can send the detailed answer for this.
And then another participant said that they need to transfer mature life insurance policy from India to USA. So do they have to pay a tax for that amount in India as well as USA?
Arvind, I believe the answer is yes, right? Be similar to kind of a stocks and mutual funds.
Yes, sir. Sir, please come again.
For the insurance policy, like let's say if they have a LIC policy that matures, now they want to bring that money to US.
Yes, sir. So some insurance policy, there are some insurance policy for which it is subjected to tax. Yes, Daddy.
Sorry, yeah, please continue.
Hello. Sir, am I audible, sir?
Yes, yeah.
Sir, that insurance policy I already answered in the chat box, sir. See, insurance policy, see, it will become, it is exempt from tax, sir. Whatever you receive is exempt from tax in India, but this is subject to some conditions. Okay? See, one of the conditions is the premium payable should not exceed 10% of the sum assured. Suppose the total sum assured is 10 lakh, your yearly premium should not be more than 1 lakh. See, it can be at any stage. It is not only yearly. There are some insurance companies which opt for ballooning system of payment. So initially you will be paying 10,000, 20,000, but at any point of time it should not exceed 10%. If it exceeds 10%, then it will become taxable, sir. So it depends upon, there are some other conditions also there. So suppose stock options, some insurance, specific insurance, it will not be exempt from tax, sir. Only a pure insurance plan, only you are getting on maturity, it will be exempt.
Okay, thank you, Paul. Satya, from US end?
US end, it is not taxable.
Not taxable. Okay, got it. Thank you. Yeah. Okay, let's move on to the next question.
Another participant said that if they're sending more than 10K money to India at one time or within a specific time, should that be called out in FBAR filing? And even if that money is gifted to others immediately, do we need to file anything in India for the money that they send?
Satya?
First question regarding the FBAR filing. So the rule is at any day during the previous year, calendar year, for US purposes. So if any person has the bank account or any other asset, financial assets, which exceeds more $10,000, then FBAR filing requirement will arise. So here in this case, if that person transferred to their bank account in India of $10,000, then even if that bank balance stays in the bank account for even a day, even if it is transferred next day, then you have to file the FBAR return.
Okay. Thank you, Satya. Nidhi, let's move on to the next question.
So are there any separate rules for like property sale or purchase for a U.S. citizen with the PIO card?
Arvind?
Arvind, do you want to take this one?
Yes, sir. Madam, please read it again.
Yeah, sure. Can you please talk about the property sale or purchase related rules for the U.S. citizen with PIO cards? So is it different?
Okay. The difference between, what is the difference between for a PIO and an NRI. It is only and only mainly with respect to an agricultural land, a plantation property or a farmhouse. So these properties by a person of Indian origin can be transferred only to residents and who are Indian citizens. Right? So PIO can transfer these properties only to an Indian citizen resident. But whereas an NRI can sell it to any resident irrespective of their residential status. Can sell it to any resident irrespective of their residential status. So that is the difference between a PIO and an NRI with respect to transfer of property.
Okay. Thank you, Arvind. Maybe let's move on to the next question.
So if parents have shares before PIS was introduced and now they have become U.S. citizens, do they need to transfer the shares to a PIS account?
No, I don't think it would be required. So we can just check up on that aspect alone, since the parents have already acquired shares when they were Indian residents, so they might not have to actually go for it. So any property which was acquired when you were a resident, you can continue to hold even when your residential status has changed. There is no restriction on that aspect at all.
Okay. Thank you, Arvind. Maybe let's move on to the next question.
The Form A2 application for remittances abroad, what purpose group name or purpose code can they give?
What is it?
Arvind, I believe this is the Form A2 that's for transferring the funds, right? Along with the,
yes, sir.
I believe that was secured by the bank, right?
Sir, that is, they want the code, sir. It is a long list of codes for various repatriation. We'll check and then get back to them, sir.
Okay, that's fine.
The A2 has got a various form codes for various types of repatriation, sir.
Okay,
so what is the purpose? So that we have to be, what is the purpose? Then we have to give that correct code, sir.
Okay, my understanding that's the form we have to give it to the bank, right?
Yes, sir. That is the form we have to give it to the bank, sir. That form we have to mention what is the purpose for which we are sending back that money, sir.
Got it. Okay. Thank you, Paul, sir. Maybe let's move on to the next question. Yeah.
And can U.S. citizens trade options in India?
What is it?
No, sir. No. Options.
Options, yeah.
No, sir. From a PIS option, no, it is not possible. PIS option is only with respect to equity share. But whereas a non-PIS NR option, we can just check and get back to you. But prima facie, no.
Got it. Okay. Thank you, Arvind. Maybe let's move on to the next question.
They said this question is for you, Mr. Mari. They said, is there a limit on the amount of inherited precious metals that can be moved to the U.S.? If so, is the limit yearly?
Inherited metals. I assume they are referring about the gold, right?
Precious metals, yeah.
Satya, my understanding is if it's a gold coin or bar, I think that probably comes under the custom duty similar to like any other assets. But if it's a family jewels or through wedding, I believe I don't think any limitations. Correct, Satya, from your side?
Okay, sorry, I missed that question and answer as well.
Oh, no, they are asking about the precious metals like gold.
Okay.
Is there any limitation when they planning to bring it from India to here? So I'm telling it depends on what kind of gold, right? Whether it's a jewelry or if it's a gold coin or biscuits. Obviously, if it's a gold coin biscuit, it's considered just like stocks or mutual fund, right? It has to be custom duty plus taxes, everything will be assessed. But if it's a family, like if they are, let's say the wife received through marriage, right? Like a jewelry. My understanding, I think that can be.
That can be. I think it is all like if it is purchased with after tax money, so that can be brought back here, showing the proper receipts and the funds that are used for purchase of the jewelry.
Okay, got it. Thank you, Satya. Let's move on to the next question.
When you transfer $1 million to the U.S., do you have to pay U.S. ordinary income tax on that amount?
$1 million? Sorry, can you read it again?
when you transfer $1 million to the U.S., do you have to pay U.S. ordinary income tax on that amount?
Oh, okay. So if this amount is transferred with the property that is sold in India or as a gift, so then there is no need to pay tax as such when they receive money here, because the tax is already paid in India as well as that is already reported in US. So this is whatever that the limits fund transfer that is happening, whether it is $250,000 or $1 million, this is just the movement of the funds from India to US. It is nothing to do with the taxation. So this is where most of the people is kind of a bit confused. So the tax point arises when the property is sold, or when the gift is received, or when the inheritance. That is the point at which we need to think about whether the tax implication arises or not. But when after the property is sold, after they receive the funds, and when the funds are moved from US to India to US, then it is not a taxable point at all. So then there is no need to include that in the income tax return. There is no need to pay tax as such.
And then if that money was gifted by a relative in India, is that taxable under the U.S. ordinary income?
Not taxable as such, because if the money is gifted by someone, again India tax rules, we need to see if it is through between the gift is from the relatives, then there is no need, there is no gift tax that is applicable. And in US the gift tax is payable by the donor. So whoever gives the gift, they need to pay tax, or they need to file the forms with IRS. But in this case, as the recipient is a US person here, there is no need to pay any tax as such on the gift.
Okay.
Maybe let's move on to the next question.
And then parents can gift to NRI using 15 CA-CB. How about filing at the receiving end to file in the USA for tax implications if it's beyond $50,000?
Again, as the receiver, there is no need to file any tax return, or there is no need to report it in US tax return as such.
If there are old PPF accounts left in India as an NRI, do you recommend that they should convert it?
It can continue. You cannot only make a fresh deposit, it can continue as such. An old PPF account can continue as such.
But I thought, Aravind, once they moved from the employer, right, from India, sometimes they ask you to take that money, or it can be just leave it with the employer in India, just leave it there forever.
Yes, sir. This is a PPF account, which is a public provident fund, and this answer has already been answered.
Answered, sir. Already have been answered, sir.
Oh, you already answered.
Okay. Answered in the chat box, sir.
In the chat box itself, it has been answered, sir.
Okay.
Once you become NRI, you lose your right to deposit in the PPF account. You have to inform the bank or post office where you maintain PPF account. You cannot make further deposit into the PPF account. The rate of interest will get reduced for the balance amount. The reduced rate of interest will be equal to the SB account interest. So initially for the PPF you are getting a higher interest, and now it would be a reduced interest. And he has also acknowledged, Mr. Avan.
Okay, got it. But from my end, I would add to that. I would recommend maybe it's better to either move the funds here if you have any need, or maybe invest at a higher rate. Because if you are not going to do that, I have seen a few cases, they sometimes just don't do anything. After some time, I think they transfer to unclaimed area, I believe. Then you have to do even more paperwork to get back your PF money.
Sir, that is applicable for dividend and all, sir. Not for the PPF account, sir. The PPF account is entirely government fund, sir. So there will not be anything transferring to other accounts. But the question, see, it is a 15-year scheme. Suppose in the second year itself you become an NRI. So after that you cannot deposit that amount, but the amount you can withdraw only after 15 years, sir. So that becomes the issue.
I see. So let's say if you want to withdraw before 15 years, what will happen? You have to pay taxes? or they
Which
don't
one, sir?
allow it?
They don't allow, sir. They don't. See, actually,
Or they don't.
after 6th year, you can get it 25% of what was the amount in the second year or something, sir. So they allow partial withdrawal. Partial withdrawal. Any withdrawal from PPF account or including interest is not taxable, sir.
Got it. So the best strategy is then at least leave it for 15 years, then take the money then.
Then take it back to US, sir.
Yes. Okay. Thank you, Paul. Okay, let's move on to the next question.
Does FATCA apply you HUF manager? Does that make sense?
Satya?
So what is the question? Sorry?
The question just says, does FATCA apply you HUF manager?
What is it?
So HUF manager concept is not there in US. It is for the individual. FATCA is applicable for each individual here in US. So I'm not sure what the specific question is, but that is the short answer for it.
Okay. I'm not sure whoever asked the question. You guys just unmute. Do you want to clarify your question?
Yeah, sure. So, if you are a HUF manager in India and you are here as an individual, as an NRI, so is there any, distinctions or gifting or all this thing is possible? Or should individual as an NRI file any FATCA for property more than $10,000, which is in hold of HUF manager, not as an individual?
Okay, I think this is one specific question that we need to look into the details, Mary.
Okay, got it. Yeah, can maybe just send me an email. I'll follow with Satya. We'll get more details about this question.
Sure, thank you.
Yeah, thank you. Okay, let's move on to the next question.
What are the steps if a person moved to the USA a long time ago but never reported any account savings or etc. in India under US taxes or vice versa?
Okay, so there are two reporting requirements for a person, US person who has assets in India. One, their annual income that they derive from the assets that they held outside of US. That income needs to be reported in US income tax returns. So I think probably that is missing. And the second one is the FBAR and Form 8938 compliances. So, so typically, I think this happens with a lot of people, and they just because of lack of knowledge and they just miss out filing or including this income in US income tax returns. So in that case, what we can do is there is something called streamlined procedure that is offered by IRS. We can go back to 6 years and file amended tax returns and file FBAR forms of last 3 years. And there will be some minimum penalties that will be that are applicable. So we need to pay that penalty and get compliant with.
Thank you, Satya. Maybe let's move on to the next question.
When an NRE account is opened, is it reported to the IRS?
Again, it is the same when if the balance exceeds $10,000, then you need to report.
Yeah, to add to that, I think now India and US is, I think, part of a lot of treaties, and I heard the banks were sharing the information. So I would recommend.
So that comes under that FATCA regulation. So they share that they internally exchange the information. So it's always better to include the FBAR reporting in your income tax returns.
Yeah. Yeah. Don't think that you may not get the audit immediately. I have seen IRS sometimes way late. They come up even after 5 years or 6 years. Correct, Satya? Yeah. Okay. Yeah, Nidhi, let's move on to the next question. Yeah.
For the sale of a property in India, are there any benefits of indexation while reporting capital gains in US taxes?
So this is another good question. So unfortunately in US, indexation is not allowed. So it's only in India that is allowed, and that is where one can get some advantage of the tax indexation in India. But in US it is not allowed, and you have to pay the capital gains tax on the difference amount.
Thank you, Satya. Nidhi, let's move on to the next question.
And there, another one is like, do you have any consulting services for Indian assets management and repatriation?
Yeah, I think they can reach out to me, whoever wants, then I will direct to the right people. So we have the chartered account and also CPA. So yes, consent service are available, yes.
And then what are the tax implications, both Indian and US, of the proceeds from an Indian life insurance policy?
I think we answered this, right?
I think we discussed before, same
Okay.
question, yes. Yeah, move on to the next question, yeah.
If a person holds land in India and later becomes a US citizen, should they open NRO, sell land, and then transfer it to the US?
So once a person becomes a non-resident, he cannot continue to hold his old SB account, his savings bank account. He has to definitely open an NRO account or an NRI account.
Correct. Yeah, that's one of the FEMA law we talked about before. Maybe let's move on to the next.
Can you close in the next 5 minutes, please?
Oh, sure. I'm sorry. Yeah, it's getting late for our Indian Chartered Account friends. Nidhi, how many questions we have?
Actually, Mr. Paul answered most of them, so...
yeah, let's go on. Yeah, just go ahead and skip all the answered one. Just go whatever the one not answered. Let's take a few more questions and we'll close the session.
Actually, everything else is like answered, so that's it.
Oh, okay. That's great. Okay, I know it's almost, we took closer to 2 hours. So I would like to thank Mr. Paul, Arvind, and also Satya, and also all the audience. I know we answered close to more than maybe 50 plus questions. As I said, the main objective is a lot of people didn't have the knowledge about the Indian side and also the US side. So our objective is try to connect as much as we can. So I hope you guys learned a lot. But in the future, if you need any consulting services, please reach out to us. Paul, Arvind, Satya, or myself definitely will help our community. Because as I said, unfortunately, it is a complex process with a lot of steps involved. So I hope it's helpful for you guys. So please feel free to reach out to us for any individual specific questions down the road. That's all we have. Okay. Again, once again, thank you, Arvind.
Thank you.
Thank you, Paul.
Thank you.
Thank you, sir.
Thank you, everyone. Thank you, Manisha. Thank you, Satya sir. Thank you, everyone. Thank you.
We will have other
Thanks for all the participants. Thank you.
Thank you very much.
Thank you.
Thank you, guys. Bye. I'll stop the recording here. Bye.